All right. Hello, everyone. Thanks so much for joining us for this breakout session. I'm Rachel Wilson, and today we have William LeBaron. He's the Vice President of Business Development for MonitorBase, as well as Louis Zitting, the founder and CEO of MonitorBase. And they're going to talk to us about how right now in the mortgage industry, we're all trying to capture as much refinance business and opportunity as we can while still trying to balance and maintain the core business. And while this is making some record-breaking months, which is amazing, there are also some issues. What potential problems are you guys seeing arise with this refinance boom?
Yeah, so what we're seeing in some of our clients, we work with banks and lenders and credit unions and brokers, and really across the board, everyone's having these awesome months as far as production. And this is amazing. And people are focusing on what they should be focusing on, capturing that opportunity, closing as many loans as possible. But what happens within this is they're dealing with stress of just record-breaking volume for processing and for underwriting, and it starts to cause issues. One of the big risks that we're starting to see within that high production is a very high level of EPO risk. So as you're closing loans at your current rate offerings, there are shops out there that are really focusing on refi, and they're able to basically compete with lower margins than you would traditionally see. And that puts your current production in the environment we're in right now with rates, going down periodically. Your current production is going to be at risk of refinancing over the next 6 months. And then besides that, we're seeing really interesting trends in just like the runoff out of the system. So when you look at the people that are actually going out and getting mortgages right now, exceptionally high credit score customers or clients are out there getting a mortgage. You're seeing a disproportionate number of high credit score, which means the low credit clients, the less qualified, are not getting mortgages. And this is unfortunate because those are the people that in a lot of ways need the interest, those lower interest rates the most. But what it means is you're seeing a lot of your, for servicers, you're seeing your portfolio runoff be in your highest credit tier customers. And that's lowering the quality of your portfolio overall and increasing your risk in the future. And it's still unclear how much that's going to impact the valuation of those portfolios in the future. And then besides that, just credit reporting restrictions that we're seeing. Lenders are out there, and servicers, they're taking clients and putting them into forbearance. And those things aren't being reported to credit, which is really a part of the I believe it was the CARES Act, right? But that was part of the legislation. It was a part of the plan. And what's happening there is there's this freeze on credit. And so everyone, knowing we were entering that, they increased their FICO's requirements. And this means, those lower credit people are being kind of adversely not able to get a mortgage. And then on top of that, there's still opportunity there. There's still good candidates in those lower FICO ranges. But we went with kind of a blunt force approach to reducing risk, and those people just aren't getting the opportunity, I think, that they should be or could be getting in today's marketplace. So that to me is where we're seeing some of the issues is your EPO risk, that runoff from your portfolio and from your own client databases, and then just you're missing out on opportunity inside of those 620 candidates. So many people bump their credit scores from that 580 mark to that 620 or 640, and there's a lot of opportunity there. They're just using their credit score as the cutoff line, when there are other ways to do it, and a little bit more, I think, with a little more finesse and still be able to capture on the opportunity that's available today.
Yeah, and I'd like to add to that, another risk of all that runoff is really just, your customer database. We always talk about customer database, but I want to define that a little bit. When we say database, we mean your sphere of influence or your community of people that you've built or met throughout the years, people that know your name or you know their name. And borrowers or home buyers have the cycle of purchase, refinance, refinance, purchase. That's kind of the average cycle of how it goes between purchases. And if in the meantime you're losing that refinance, you're losing them to another lender that now has that relationship as well, so that when the purchase comes around, they may go to their bank that did the refi or whatever that may be. So we understand the reason, and we're absolutely not saying don't focus on the refinances. You want to retain that customer for the next purchase. But it's still, it's people are starting to lose focus somewhat on their core business of the purchase and referral partner relationship.
Yeah, that makes sense. So what are you guys seeing other lenders doing to cut down on some of those EPO risks and those runoff risks?
From the lenders that we're seeing, the banks, because banks have always had a lot of access to big data, and they're using that access to data to really build systems and take a really data-driven approach to address the problem. And so, a bank is at an advantage, or a credit union. They're servicing their portfolio, and so they can do account review, and they get just unbelievable amounts of access to the behavioral data of their clients. So they're really able to dial in and know who is at risk. Someone requests a payoff, they know that that's an EPO risk. Those are examples of how it's been done in the past for some of the really big institutions. But there are really similar tool sets and data available for lenders and brokers, I mean, at all levels now, to really capitalize on what I guess the big guys have been doing all along. You have to get a little bit creative and take some. You have to start looking into what those people have done and what's available as far as the data is concerned. And so if you think about those same risks that we're talking about, a big bank who's servicing the loan has had access to all kinds of data on what the client's doing, what they're spending their money on, payoff requests, credit pulls, and so on. And they've had that access for I mean, honestly, probably decades now. And they've been able to act on it and systematically approach the problem. It's just now that lenders and brokers and even some of the smaller banks and credit unions are getting access to similar data sets, and they're using that data to build systems and address the issue.
Okay, and you said like a lot of the big banks and big lenders have always had access to all this data. How do you see them using it?
So, I mean, if you analyze the business right now, you've got kind of an interesting situation. Volume is so high and profits are so good and people are making so much money that it hides all of the problems. And so the truth is, all of these lenders and banks and everyone, they're dealing in the same space of really record high volume, and so none of the issues are really apparent. But what happens when if rates drop or you have new fees or structures come into place and that refi business drops down, it's like the tide going out and it uncovers all of the rocks and everything that was covered. And so you have to start analyzing and really understanding what are your weaknesses, because not everyone is exposed the same way. But they're looking at it and saying, okay, if we're closing loans and here's an example, we're not a low margin shop. We were traditionally purchased before, right? We weren't offering the most competitive rates, but we offered a very good service. We have great referral partners, and our business functioned really well. And right now, in today's environment, you're not having to be as rate competitive, and so you're out there doing awesome things. But to be able to analyze and understand, are you a high risk for EPO lender? And if that's the case, starting to look at, for data sources to preempt and start solving that EPO risk, before you're getting the notice that the investors recapping, all of the yield spread on that loan.
One more thing that I'd like to bring up, and this is kind of a second hole in the boat, is, we've talked about losing focus on the core business, and we do see and we hear from a lot of people, they're saying, I have so many transactions, but I'm really dropping the ball on my referral partner relationships. Some people have decided, no, I'm going to still heavily focus on that, because that's what happens after all of this refinance fun, or when the refinances dry up at some point. So this is a really good opportunity for people to build those new referral partner relationships, because everyone's so busy that those relationships are getting neglected. But also, say you're an entry-level loan officer, you're not seasoned and have all these great relationships. How do you break into that market of building referral partner relationships? Well, it's not going to be when transactions are very scarce. So this is, that's somewhat of a hole in the boat for some people, but it's still an opportunity for people to go out and build these new referral partner relationships when they just, they need service. And And the entry-level loan officers also, they haven't built this database or community of past clients that they're feeding off of for refinance transactions. And so those newer loan officers really have the time and the opportunity that they could go and start building relationships.
Yeah, definitely. And when we talk to our, like, it's just some of our bigger clients, that's the executive concern. I mean, meetings just this week where these loan originators are not focusing in on that purchase business and that realtor relationship. And the lender understands why. It's not like anyone's looking at it and saying you're doing everything wrong. They just know that they put themselves at risk by not treating them with as much care as they have before. And honestly, there's stress on those relationships either way, because your title companies are busy, your attorneys and your closing, your processing, your underwriting is slower. All of these aspects of the system are stressed and slowed down, and it's because you're so successful and you're breaking records and you're doing so many awesome things. But the truth is that is harming these expectations of what these realtors or these referral partners have gotten used to. The client experience isn't as smooth when you double your volume, and people are trying to shore that up. But I think it's interesting to note that there's stress on the relationship, regardless of whether or not you're neglecting it. And so the added level of if loan originators aren't really focusing on those, is just another aspect that's contributing to the issue.
Yeah, and more on those referral partner relationships. There's the new opportunity here is the collaboration on data. It's always been collaborating on co-branded marketing or just basically having good relationships with these people. If you can get the deal done, then you're going to keep those referral partner relationships. But we're definitely seeing in the especially in the mortgage space now, and this has always happened with or it's been happening with Quicken and Zillow, to where they're kind of the one-stop shop. But there's opportunity in collaborating on maybe this is the realtor referral partner's audience, this is the lender's audience, and really the value there is the relationship with that community. And there's really so much data available that they don't necessarily have to have that one-on-one handoff, face to face or over a phone call. Just the fact that that you would have kind of a shared audience can really bring that community feel to it. That's going to be much different than what they're dealing with the large Quick and Zillow type of organizations.
Yeah, awesome. So you guys have mentioned a lot about the data. So how is everyone out there getting the data, and how do they make it useful?
I think it's a big question, but it goes back to earlier, like, what are the things that your company is worried about? If you're worried about EPOs, then it's a totally different answer than if you're worried about runoff on your service portfolio, or if you're worried about losing your realtor relationships, or if you're thinking about capturing more realtor relationships. So it's kind of a question of which problem you're trying to solve exactly, and then the answer is pretty easy. If you're trying to solve retention issues on your service portfolio, that's something that we could go into detail on, but we don't really like that. That's not really what we're going over in total detail today. Maybe Lou, you can comment on that.
Yeah, I mean, kind of the way that a lot of people were doing it was follow up periodically with your customers, or look for a payoff alert or something along those lines. But there's so much more granular data available on people, and activity sort of data that like you mentioned, the banks and credit unions, they have access to that because they can see the movement inside of these accounts or logging in. And in the past, we talked to a lot of lenders that think, I don't have that data, I don't have that information. And that may be the case. They may have more than they think, but there's also so much of that becoming available every day. And I think that's the shift that we're seeing to happen, or starting to see happen, is realizing that there's this information available, down to the loan amounts, the activities that people are taking in their financial lives, and then figuring out how to take that massive amount of information and distill it down to something that an originator can act on. Because big data has always been a conversation, and a lot of the lenders are adopting good, great business analytics. But what about on the prospecting side and the amount that you can know about these consumers in your sphere of influence, or your referral partner sphere of influence? And that's the shift we're seeing. There's people starting to embrace that and realize the value of that, as it becomes more and more readily available.
That's awesome. And then when using this data, what kind of things are possible?
So it's a good question. I kind of want to back up to that earlier question. So you asked, how do you make the data useful? And I think it's a similar question here. So, once you've identified the problem and maybe you're the corporate office, you're the C-suite, and you're looking at this and you're saying, how do I, okay, I get access to the data now. What do I do with it? And Louis kind of mentioned it or alluded to it. There's an aspect of balancing the fact that you at a corporate level can start looking at these things and analyzing and understanding what your risks are and what you could do with the data. But it inevitably comes back to, how do you start taking that data, processing it into a useful format, and giving it to the team? And there's really a limitation to what a mortgage company can do. It's not like you're talking about just launching a marketing campaign and that solves your EPO risk. It's not like you can solve it with an awareness campaign. But with good systems, imagine you can notify the originating loan originator, or the originating loan officer, that client has just started that loan process with another lender and they're within an EPO risk. And you can be systematic about it. You can offer more competitive rates for a repeat customer, in that kind of a scenario, in order to help recapture that loan with you as a lender, once they're outside of the EPO risk. And that's something that you have to collaborate between originator and corporate office and marketing teams, and you have to build those systems. And it kind of goes in place to that same retention issue. You've got to approach it from kind of a top level view down and say, if we can get access to the data, and it's not like data isn't that expensive. It's really about building systems and approaching it systematically. And if you can build those systems in place, you can solve EPO risk or address EPO risk and really mitigate it. You can start addressing retention issues by identifying the right people and then really turning that into a digestible or an actionable set of events. And obviously, collaboration down to the originator level is really key in a lot of that, because, and Louis, you can comment on that as well.
Yeah, I mean, that's really the main point. It's you got to get it back to the person with the relationship so that they can make that phone call. I mean, if it's a call center from the mothership, then they're not even going to recognize the phone number, where the originator can make a call and they might recognize that on their phone and it doesn't look like a spam call. It's that's really important to get it back to the person with the relationship, with a really simple call to action and very timely, because the loan originators are busy. They're chugging through loans and working on loan problems and doc problems, and so it needs to just come to them really simply of like, hey, here's this person, right now is a good time to reach out. You already have the relationship, so it's not a scary phone call, and that seems to be what's worked best that we've seen.
Yeah, and I kind of want, earlier, one of the points was, we were talking about these lenders increasing their credit score requirements. And one of the things we've seen that's possible in the data is some of these bigger banks they're just not even using credit score the same way as they used to. They're looking at alternative credit data, and it's allowing them to mitigate risk because it's good data. You're able to rank candidates. I mean, we all know that your 640 FICO, not all 640 FICO clients are equal, and some of those are on a downward trend and some are on an upward trend, and so they're using alternative data to kind of sort through it, and they're becoming more comfortable doing these loans in what would, from a score perspective, might be in that 620 or 580 range. But from these alternative data points is a lot less risk. And the unique thing is there's a lot of margin in those loans, and that's a lot of opportunity that's lost. So that's just examples of what are the components where you guys feel like as a company you're missing out on, and then starting to explore how you might be able to approach those or address those issues.
Yep.
Yeah, and you briefly touched on what can happen if you don't do these things and the risks of that. So what do you see the risks being of not accessing this data and not using it to your advantage?
So I mean, a lot of lenders right now they're kind of stockpiling cash. They're making money and they're profitable, and that's awesome. But they're trying to hedge against future risk, and hedge against when rates slow down, and they're trying to build system. And so as you're going through this, it's really about understanding your own the risks that are associated to your company and your company specifically. And so if you can mitigate EPO risk, that is a direct effect on the bottom line for at every level of the mortgage company. And so I think it's about understanding your own company and understanding what it's costing you to not address these issues, because I kind of want to go back to that metaphor. The tide is high. It's covering all of the problems. And if you take a moment and analyze where you feel like those problems are going to arise when that water recedes, then you can start looking at what that is actually costing you. Because when everyone's so busy closing so many loans, it's really easy to ignore those aspects of the business. And so that's really what we see as far as the risk of not taking action right now. I mean, we're a data company, and we've sold refi data, and we are on the same business cycle as the mortgage industry. So inevitably we know, and we know that the refi business is going to recede. It happens every single time, and anyone that forgets that, they pay the price. And so that's just kind of our thoughts, or my thoughts on that right now.
It's not so much about lost opportunity at the moment. There's a lot of opportunity inside of your data that you can use to originate more loans. Right now, people aren't thinking about needing more opportunities, so it's really about the opportunity that could be lost after all of this crazy volume slows down. I think that's where the risk is, and not just really kind of planning for it and starting to test out some systems while times are great, and so that it's not just the tap gets turned off at some point, and then everyone's scrambling around trying to figure out how to keep all the processors and underwriters employed. It's be ready. Right now is the time when times are great. That's when we prepare for the slowdown in the next cycle. And so and like William's saying, these aren't the things that people are really seeing, but we're seeing them in the data. There's a couple holes in the boat. They're not too difficult to solve, and luckily the data and technology's just getting better and better to solve those issues.
Yeah, that's awesome. So accessing and utilizing the data helps you keep more clients, avoid losses and early payoffs. Thank you guys so much for going over this with us. It looks like we're just about out of time, but thanks so much to everyone listening, and we'll catch up with you later.
Okay, thank you.